Welcome back to Global Strategy, the podcast that helps you move beyond survival and into real prosperity. I'm your host, Alex Chen, and today we're tackling a topic that is foundational to wealth protection for millions of people across Latin America, yet it's deeply misunderstood. The simple act of putting your money into US dollars.
And I'm Dr. Sophia Reyes, a financial strategist specializing in emerging markets. Alex, it's great to be here. This idea that the dollar is the perfect, impenetrable shield is a myth we absolutely have to shatter, or at least challenge, today.
Exactly. Dr. Reyes, for decades, the mandate across countries like Chile, Colombia, or Argentina has been universal. Get your money into dollars. It's seen as a financial lifeboat, an ocean liner escaping the local unstable boat. But you're arguing that this ocean liner is not immune to every storm.
That's the core thesis. Look, the US dollar is, indisputably, the world's reserve currency and the global anchor. It's an essential shield against local hyperinflation and devaluation. But when a Latin American investor buys a dollar-denominated asset, say an Apple share or a US Treasury bond, they trade their familiar local risks for a new complex set of global, regulatory, and systemic risks. And those are the invisible risks we need to make visible.
Context. Why this conversation about the hidden risks of the USD matters so much right now.
Because global volatility is high, Alex. We're in a phase where the Federal Reserve is aggressively shifting monetary policy. Global trade tensions are high, and simultaneously, many LATAM countries are experiencing significant internal political and currency swings. The margin for error is shrinking. If you think your $1,000 investment is safe just because it's in dollars, you are overlooking factors that can erase your gains. You're trying to achieve real purchasing power, not just the nominal number on a screen.
That's a fantastic distinction. Real purchasing power versus nominal gain. Let's dive into the first and arguably most insidious risk you identify, silent currency risk or FX risk.
Currency risk, or FX risk, is the one that confuses people the most. It's the constant, subtle tug-of-war between the USD and your local currency, let's say the Colombian peso, COP.
Give us the metaphor you use to explain this.
The glass of water metaphor. Imagine your USD investment is a glass full of water. The value of the water itself, $1,000 USD, never changes in the US. But the container you use to measure that glass, your local currency, is constantly changing size.
Right, so if my local currency, the container, shrinks dramatically due to local instability,
it takes many more of those smaller containers, pesos, to fill the glass. That's the short-term joy. Your USD investment suddenly buys a lot more locally. But that gain can be an accounting illusion if local inflation is skyrocketing. The dollar bought more pesos, but the pesos buy fewer goods.
That's the common scenario in LATAM, where the local currency depreciates sharply. But what about the other side of the coin, the silent devaluation of the dollar itself?
This is the risk that gets ignored. You invest $1,000 USD, the local economy stabilizes, and the peso strengthens globally because, say, commodity prices are up. The exchange rate moves from 1 USD being 3,000 COP down to 2,800 COP. Your $1,000 investment is still $1,000 in the US, but when you bring it back to COP, it's now only 2.8 million COP, down from 3 million. You made 0% in USD, but you've lost over 6% of your local purchasing power. You've been silently devalued, not by your local government, but by the global dynamics of the dollar.
Wow, so a successful USD investment in an asset, say it gained 5%, could still be a net loss if the dollar weakened more than 5% against your home currency in that same period.
Exactly. That's why your KPI, your key performance indicator, shouldn't just be the asset's return. It must be the combined return of the asset plus the USD/local currency movement over the exact same period. It's the only way to measure your true wealth creation.
Core discussion. Risk Pillar 1. The Sleeping Giant. FX Risk. Core discussion. Risk Pillar 2. The Global Climate.
And then we move to risk pillar number 3, which is often a nasty surprise for the unprepared: the paperwork web, regulatory and tax risks. Dr. Reyes, many Latin American investors believe that moving money offshore makes it invisible. That's a very dangerous assumption now, isn't it?
It is catastrophic. That era is dead. International agreements like FATCA and the OECD's information exchange standards have made financial opacity a legal risk, not a viable strategy. Your offshore investments are a luxury product crossing a bridge, and at the end of that bridge is your local customs office, which is your tax authority, whether that's the DIAN in Colombia or the SIA in Chile.
What are the main tax challenges here?
First, double taxation. You might pay capital gains tax in the U.S., and then your home country expects you to declare that gain and potentially pay the difference if their rate is higher. Second, the dreaded wealth tax or patrimony tax. Some countries tax not just the income from your assets, but the total value of the assets you hold abroad. This can severely erode a low-yield portfolio. And the third and most technical is the exchange rate risk in tax payment.
This is brutal. Let's say you sold a USD asset for a $5,000 USD gain. You prepare your tax declaration months later. The local tax office calculates your tax obligation in pesos using the exchange rate on the day of the sale. If your local currency depreciated significantly between the sale date and the declaration date, the taxable amount in local currency has grown much, much larger.
So the local currency depreciation, which made your USD gain feel bigger, actually increases your tax bill in local terms. That's complex.
It is. And regulatory risk, the CEPO, or exchange restriction, is another factor. Countries with instability can limit the amount of USD you can buy, sell, or transfer overnight. Even if your broker is sound, getting the money home can become a bureaucratic, expensive nightmare.
The key takeaway is clear. Tax advice from an international specialist is not optional, it's mandatory. Core discussion. Risk pillar 4, the market wave. And then we move to market risk, pillar number 4. When LATAM investors leaped into the global market, they usually gravitate toward one thing: the big U.S. tech brands, the FANG stocks, the NASDAQ. What risk does this concentration create?
It creates the fallacy of inverse home bias. Home bias is investing only in your small local market. Inverse home bias is running away from your local market and putting 100% of your international capital into one foreign market, the U.S. While the S&P 500 is diversified by sector, it is not diversified by currency or geopolitics.
I see. So if the U.S. tech sector has a massive correction, like the dot-com bubble in 2000, you've exposed your entire international hedge to that single concentrated risk.
Exactly. And let's combine that with the FX risk. Often, when the U.S. market corrects, capital starts returning to emerging markets, seeking value, which makes your local currency appreciate. So you are hit by a double whammy. Your tech portfolio drops, and the dollar weakens against your peso or sol.
That's terrifying. What's the market advice here? Beyond the U.S., where should a globally minded LATAM investor look?
True geographic diversification. Your portfolio needs exposure to other major economic blocs: Europe, Asia, places like South Korea or Taiwan. A simple, cost-effective way to start is with a global ETF, like one tracking the MSCI World Index. That way, if the U.S. has a rough year, you have sectors and economies operating on different growth cycles to potentially smooth out your returns.
Diversification is the highest authority, not just sectoral, but geopolitical and currency-based. Emotional and psychological insights and practical application. Dr. Reyes, before we summarize, let's talk about the human factor. You mentioned that the biggest risk is the human factor, decision-making based on panic or euphoria. How does a LATAM investor who is already conditioned by decades of local crisis manage the psychology of investing when their local currency is plummeting and their USD portfolio is volatile?
It's incredibly difficult because their entire mental framework is built on survival. They see the local currency drop and they feel a rush of relief because their dollars are now worth more. But when the dollar investment drops 10% due to a tech correction, the panic is absolute because the shield feels broken. The key is discipline and continuous education.
Discipline in what sense?
Define limits. Establish a maximum acceptable loss amount before you invest. Use a strategy like dollar cost averaging, DCA, where you invest a fixed amount regularly, regardless of market peaks or troughs. This removes the emotion of trying to time the market, which is a fool's errand.
And the continuous education.
It's understanding the complex correlations. Why does the yield on a 10-year U.S. Treasury bond suddenly affect mortgage rates in Chile? Understanding that correlation transforms you from a passive victim of global events into a proactive strategist. You stop trusting a platform blindly and start trusting